Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax efficient or tax free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no cost, no obligation consultation with me. Enjoy.
Good morning, everybody. Happy Tuesday. It is July 20th. I am just off of a week of vacation. It wasn't really a vacation. I worked most of the week, but with working on some videos and things like that, my son, who's helping me with this, but I tell you, I've learned that he's brilliant with this process, and that's what he does for a living, but in the music industry. So with that said, I have two of my sons actually working with me now, working on these, keeping track and editing and uploading all these videos. My son from San Diego is really a sound engineer, and he produces music, and so I've got a new microphone, so I hope you can hear me okay. And it was a productive week, but it's great to have family in town. We had a very, very busy weekend. I had about, I don't know, somewhere between 40 to 45 members of my family here over the weekend. Did a lot of cooking on that hot Saturday we had here in Pennsylvania. So it's been wonderful, but I missed you all last week, and I'm looking forward to seeing everybody again. And we have, of course, this webinar and then another webinar tomorrow. So just checking the new microphone. Just raise your hand if you can hear me better or hear me okay. Excellent. Thank you. So I want to share with you to start things off that we do have, I don't know if you've noticed, but I've been promising you for some time now that we would start having these webinars and our special webinars on our webpage. So I'm going to share with you the Attleboro Wealth Management webpage, and the URL, the web address is just attleborowealth.com. So you should see that in front of you now. And I really, really like this webpage. I like the look and feel of it, but we're going to be changing it a little bit because that's just what you always do. But I've showed you before the slot corner here, but I want you to go to events, and under events now, instead of just, I think it was just live classes or weekly webinars. Now we have 3 drop downs: weekly webinars, special webinars, and live classes. Now I don't have any live classes scheduled yet. I'm in discussion with the group that helps me put those together. We're just trying to find out if when the best time is and to have that happen again. So we're going to work on that. So if you go to the live classes, we're not yet showing any live classes. And if you go to weekly webinars, what you have is the registration for our weekly webinar. So you can register here. But this is the exciting part. If you go to special webinars, you're going to see these webinars begin to populate. So there's not a lot that I can, don't pick on me about the pictures here. There's not a lot I can do with the thumbnails. This is all done through YouTube. These are embedded videos, and they don't offer much by way of thumbnails. But you'll see here that this is the last special webinar that we had, and that's fiduciary planning for powers of attorney, trustees, and executors. So you can actually watch this, click on it. It takes you right to YouTube, and you can view it there. We also have using annuities in retirement planning and wealth conversions. We have 2 of my webinars with David McKnight. This is the one here where we just talked about what's going on in the world. And this is back in January, believe it or not, I think it was. We have a Brian Adler video here. This is the estate planning part of one of the advanced classes. We are working on editing and uploading the great discussion we had about revocable trusts. This is a really popular webinar with Steve Bobber, Know Your Medicare Options. And then, of course, the Ed Slot event we did last May. And then this is the other webinar I did with David McKnight last April 2020. And that's where he does his flagship Power Zero presentation, and that's a really, really great video to watch too. Because you've all seen me do the Power Zero presentation, the final exam, but nobody does it better than David McKnight. So that's worth a watch. So we're getting there. It's really exciting. Take some time if you can and go through whatever video you'd like to see. But the weekly webinars are coming. We're working on it, and they'll be what we're working on right now with the web developers, kind of where to put this on the page. I think this big snapshot here is just going to disappear, and then you're going to see the thumbnails with the registration. So we're working on that now. So that's exciting, and I hope that's exciting to you. But tomorrow we have another special webinar, and tomorrow we're going to talk about investment fundamentals. So this is going to be basic for sure. We're going to talk about stocks, bonds, cash, mutual funds, exchange traded funds. We already talked about annuities, so we're not going to talk about annuities. And we'll build on that as we move forward into other special webinars, because there's a lot of things I could talk about when it comes to investments. I'm of course going to talk about the 3 pillars of investment, and that's asset allocation, principal protection, and account segmentation. But that should be a good one, and that's tomorrow. Tomorrow night at 6:30. So I know you've been receiving emails. I have another one scheduled that you should receive tonight, and then another one an hour before the webinar tomorrow. And hopefully everybody who wants to see that has an opportunity to see it. But it'll be up on the website within a week. It's taken us about a week or two to get these edited and then gone through our compliance review and then up on the website. But again, really, really happy about that. All right, so today I'm going to spend time talking about the markets. I just have a little bit of financial planning to talk about, and it may be a shorter webinar today. It may not be. We'll see how that goes. But there's a lot of slot updates over the past 2 weeks that I thought were really good. One thing in particular, there was an article in MarketWatch that came across my screen yesterday or over the weekend, and it was discussing using Roth IRAs as your short-term cash reserve. And I'm going to just talk a little bit about why I really don't think that's a good idea. You can certainly draw on Roth IRAs, or that 5-year rule. That's a little complex prior to age 59. It's a lot less complex after age 59. But I'm just going to talk about why Roth IRAs really aren't good for short-term cash, in my opinion. So let's talk about the ad slot updates and what's been coming through my email box from the Slack group that I want to share with you. And then we're going to talk about the markets. I know the markets are a hot topic today. Today especially, the markets were down over 700 points yesterday, and there's a lot of concern out there from people and even some of the analysts I'm reading. But we're gonna talk more about that. So let me just move my box there. All right. So Sarah Brenner from the Ed Slack group is one of my go-to people. I think I tell you all the time that Sarah's the first one I pick up the phone for usually. She did a really great, just kind of takeaway email from the Ed's Instant IRA Success Workshop, he calls it. And that workshop that I went to in 2011 is what really changed my life when it comes to financial planning and how I see the world and the great work we've been able to do for our clients. So they had one of these July 15th and 16th. There was a virtual workshop. And these are the key takeaways from that. And I just want to share them with you because I think they're spot on things that we should be paying attention to. So the first one was the Secure Act has upended retirement planning. Boy, that's the truth. The Secure Act became a reality in 2020, and with it came the end of the stretch IRAs for most IRA beneficiaries. So if you're in one of my classes prior to 2020, you heard me say, we have this thing that's kind of unofficially called the stretch IRA, where you can, if you're a non-spouse beneficiary, if you do it correctly, and it has to be done correctly, it's very important, you can take distributions over your lifetime. And we have many clients, second generation clients, who are in that situation. We were just chatting with one of them today, because we do our required minimum distributions. We schedule it. We try to have them at the birth month of the recipient, because when you try to do them all at the end of the year, it can get very difficult. And we don't want to miss them, of course, because if you miss a required minimum distribution, what is the penalty? penalty is 50%, 50% of what you should have taken. And that's a big one. And it's unnecessary and unfair, in my opinion. It's also one that often gets waived, at least the first time, if you do it correctly. So you would have heard me say during these classes that at some point, the stretch IRA is going to go away. And sure enough, here we are, 2020, that stretch IRA was essentially eliminated for most beneficiaries. In its wake, in the wake of the Secure Act, there are many questions about new rules and where to go from here. And when it comes to transferring wealth to the next generation, a lot of questions. And this is where I rely on the Slack group so much. At the workshop, there was much discussion as to the correct interpretation of the new 10-year payment rule, especially in light of the recent confusion related to Publication 59B. The IRS put out this publication that said the 10-year rule applies in a way that none of us thought it would apply, and that is you have to take a required minimum distribution. All along the way during the 10 years, all of us really thought that it was going to act like the 5-year rule, where it all had to be distributed by the end of 5 years. So there was then the IRS revised that publication, and they said no. In the revisions, they corrected what they originally came out with, and they said there would be no RMDs during that 10-year period. So you could wait until the end of the 10-year period. So the IRS gave us some confusion on the end direction, and then corrected it in a relatively short period of time looking back, but during the time we didn't know. So it's clear, Sarah writes, it is clear as well that there is a lot of interest from both advisors and retirement savings in potential replacements for the stretch IRA, such as life insurance or charitable trusts. A lot of discussion around life insurance as a replacement to required minimum distributions. And charitable trusts, for some people, I'm finding, I found over 20 years that there are people who are very, very charitably inclined, but the majority of the people don't. They do their charity contributions during their lifetime. And if they have a balance left over, they certainly are willing to put a significant amount or some of it to charities. But most people want to really make sure their lifestyles are taken care of first, which is the right thing to do. Many people believe we are headed for tax increases is the second point. So even the naysayers out there that I used to come across are very, very few. So I've been having this discussion since 2011. So for 10 years, and it used to be common that I would run into CPAs or individuals out there who would kind of fight me on the idea that taxes have to increase, but they're very, very few and far between. And if you've been following me, if you've heard me say this a million times, we believe that taxes have to double in the next 10 years, if not sooner. And our studies show that the average middle-class American will be in the 40 to 45% effective tax rate. So we won't know if I'm right until we look back in that rearview mirror, but mathematically, I don't know how we avoid it. So Sarah writes, many believe we're headed for tax increases. There's much uncertainty when it comes to tax planning right now, stemming from concern that today's tax rates won't be around long. Several informal polls taken during the meeting show that many advisors believe that the historically low income tax and federal state tax are likely to rise in the near future. The third point she makes is the net unrealized appreciation tax break is currently generating a lot of interest as the market booms. So as we've had such high growth in the market, net unrealized appreciation is discussing company stock in a retirement plan. This is often missed when someone retires. The individual retires with company stock in their retirement plan. They roll over their entire balance of their 401k into an IRA. Often out of haste or getting bad advice, and they lose the opportunity to save significant tax potentially on what we call net unrealized appreciation, or NUA. So NUAs are very, very complex topic, but it prompted me to write this down for a future special webinar. We'll talk about NUA. But let's just put it this way. If you have company stock in your retirement plan, before you roll it into an IRA, because it cannot be reversed, have a discussion with us or somebody else who specializes in this kind of process. IRA trusts may be useful, but for some IRA owners, they are still needed. The Secure Act may have downgraded trust as a planning strategy for IRAs with the new 10-year rule for most beneficiaries, including trusts. However, advisors recognize that for some situations like minor beneficiaries, special needs beneficiaries, that's a very common item right now too, and those with credit issues, a trust may be a good choice. Advisors and their clients are eagerly waiting on the Secure Act guidelines from the IRS to fill in the gaps on how the rules for trusts as IRA beneficiaries will work going forward. Another great thing about the Slack group, we're always getting updates, always getting these updates on the IRS filings, filings, follow-ups, things like that. I wish every financial advisor out there was required to be in this group as part of their training and certification. I just don't know how others do it without it. And you can't count on, believe me when I tell you, the Merrill Lynch's of the world, the UBS, the Wells Fargo, all these large firms, they don't offer these resources. I've been there. I know. The fifth item she writes, and she's absolutely dead on with this, is Roth still rule. Roth accounts were subject to a lot of attention during the workshop. We had discussions about the recent news reports of tech titans' multi-billion-dollar Roth IRA, stories of continued client interest in Roth conversions, and reports that Congress move toward more Rothification. Knowing the rules, including the most often confusing 5-year rules for tax and penalty-free distributions, is more important than ever. Absolutely. You've got to work. If you're going to embark on this strategy of Roth conversions, having your money in Roth IRAs, making sure that you maintain that tax efficient or tax-free retirement lifestyle or positioning in your accounts, then you've got to know the ins and outs of that. So good work, Sarah. Okay, moving into some of the others. So this comes from Ian. This is from the Slack group as well. These are what I'm going to share with you now are letters that come into the Slack group. And Ian Berger, who's an attorney, Sarah's an attorney as well. He's also very knowledgeable. He's quite funny too, but he's the one that answers a lot of the questions that come in. So this is an individual who writes in about a coronavirus related distribution. Now, in our practice, we only had one of those. So they're not common for the folks we work with, but I'll share this with you anyway. So they write, Mr. Slott, would a person who took a coronavirus related distribution or a CRD from his IRA in 2020 with the intent to pay it within 3 years be disqualified from taking a distribution and making a 60-day rollover in 2021 if it is within 12 months of the CRD? So what they're talking about is there are very strict rules for the once per year rollover rule. And if this person is concerned that if they took a CRD in 2020 and then they want to do a 60-day rollover also, are they violating that 60-day, and it's within the 12 months, are they violating that 60-day rollover rule? If they violate the 60-day rollover rule, that amount that they're intending to do a 60-day rollover, some people take these in short-term loans, then that will be fully taxable. What I'm reading into this question is that this woman, Betty, is needing the money, and she's trying to avoid paying the tax on it coming out on that 60-day rollover rule. So it's a really, really good question for Betty. And Ian's answer is the repayment of a CRD, coronavirus related distribution, is considered a trustee to trustee transfer between IRAs. So basically, the rule said this is not treated as a 60-day roller. It's just as if you took it from one IRA and put it directly to another IRA without receiving control of the money yourself. As such, Ian writes, the once per year rollover rule does not apply. Therefore, there would be no reason why a 60-day IRA rollover could not be done within 12 months of the CRD. That's a really good point. Now, this next question comes from a financial management firm or a financial planning firm. And again, I'm going to get off my soapbox, but this is someone who probably should get involved in the Slack group. So they write, hello, we had a question on Roth conversions in our office that is stirring up quite a debate, and we're hoping that you could add your expert opinion. Here's an example. Bob Smith, age 65 in 2021, U.S. resident, U.S. citizen, U.S. tax filer. Bob has a traditional IRA worth $100,000. They write with no cost basis. That simply means it's all pre-tax money. In January 2019, he opens up a new Roth and converts the entire $100,000 amount into his new Roth via a Roth conversion in January 2019. Bob pays the tax due in 2019 for his Roth conversion on his federal tax return. In January of 2021, Bob takes a withdrawal. So 2 years later, Bob takes a withdrawal of $10,000 from his Roth conversion account. They further say, let's assume that Bob invested the funds in the money market and his Roth is still worth the original $100,000 at the time of withdrawal. So their question, there's other facts here. So question, has Bob violated the 5-year holding rule that would subject him to the penalty, or is he exempt because he is over age 59 and a half? So the answer, and you probably know this, but here's the answer. Distributions of Roth conversions are never subject to a 10% early penalty if the individual has attained age 59 and a half. So Bob's distribution would be penalty free. If he were under 59 and a half, the 5-year holding period would apply and he would still have to wait until 2024 to receive a penalty-free distribution. So he's talking about the penalty. He's not talking about the tax on the growth. Tax on the growth would be a different story if they remove any of the growth portion of the, so Ian, I think this was Ian I said, right? Ian could have probably answered this in a little more detail, but the answer is 100% correct. You're over 59 and a half, that 10% penalty doesn't apply when it comes to distributions from your Roth IRA. Further, if he took $10,000 out of $100,000, no penalty, no tax either, because there are ordering rules that the IRS has. And the first is any contributions are returned penalty-free and tax-free. Any conversions, tax-free, penalty-free. Anything, then you get into the growth component. So really good answer from Ian. All right, and I think this is no, I've got a couple more here. We've got a lot of information from Ed Slott, so let's see if I can. One's about qualified charitable distributions. If you have questions about qualified charitable distributions, then ask me questions about a qualified charitable distribution, or commonly called a QCD, is a way to directly send money, part of your RMD money, to charity, so it doesn't go through the filters of whether it's a tax deductible charitable contribution. You can contribute it right to your directly to your charity. It's like it doesn't stop and go. It just goes right to them. There are some qualifications for that, and we can talk about that individually. So the next question is, we are reading several interpretations of the new 10-year rule for designated beneficiaries for our inherited IRA. This is a good question, I think. Does the 10-year rule begin in the year following the original account owner's death? For example, the account owner dies in 2020, the clock begins in 2021, and the account fully liquidated by the end of 2030. So they're saying, when does that start? Is it the IRA owner dies in 2020? Is it the year following 2020, or is it 2020? Therefore, do the funds have to be distributed by the end of 2030? So they write back, you are correct. The funds need to be distributed by December 31st of the 10th year following the year of death. If the IRA owner dies in 2020, the account would need to be emptied by December 31st, 2030. All right, so one more. This is another one from Sarah. So Sarah Brenner. How you can reduce your required minimum distribution. So we all know, all of you know, at age 72 now, there is legislation talking about age 75. Let's hope that goes through by the end of the year. Although, I don't know if much is moving in Washington right now. At age 72 now, the year you turn 72, you trigger required minimum distributions. So in that first year, you don't have to take it until April 1st of the year following the year, but every year after that, you have to take a required minimum distribution by the end of the calendar year, December 31st. But are there ways to avoid that? There are ways. A QCD, so qualified charitable distribution, we just talked about it, up to $100,000 if you're this is confusing, right? Because it's still age 70 and a half, but there are some limitations. You can send part of your RMD or all of it if it reaches the threshold to directly to a charity. Satisfies the requirement of distribution, but you won't have to pay the tax. A still working exception. So if you're still working over age 72 and you don't own more than 5% of the company you're working for, you can qualify for the still working exception, but it's only for your retirement plan monies, your 401k, for example. IRAs don't apply. Once I had a client many years ago who was advised by another advisor to roll her 401k into an IRA while she was still working, and she immediately had to pay required minimum distributions. She could have kept it in her 401k while she was still working and not paid requirement distributions. So there is that still working exception. A QLAC, the heck is a QLAC? A qualifying longevity annuity contract. That's a product designed to help with longevity concerns. Any funds you invest in a QLAC are not included in your balance when it comes to calculating your RMDs until you reach age 85. So it's like a deferral. You defer a part of your IRA to this qualified longevity annuity contract, but you have to then it's not calculated until you reach age 75. This will reduce your RMDs. You can purchase a QLAC with a lesser of 25% of your retirement funds or $135,000. The 25% limit is applied to each employer plan separately, but it can aggregate an IRA. So there is the QLAC. I haven't used the QLACs at all that I can think of in retirement planning, but it is a tool out there that we could use. And of course, the big one, Roth conversions. If reducing RMD is a top concern for you, you may want to consider a Roth conversion. Sarah writes, this is because you're not required to take RMDs from your Roth IRA during your lifetime. While conversion is a taxable event, you can exchange a one-time tax hit for a lifetime and never having to worry about RMDs and their tax consequences. Keep in mind your beneficiaries will need to take RMDs from the inherited Roth IRA. However, these distributions will most likely be tax-free. I like that she writes that. The sweet spot. So once this is the last bit from Sarah. Once you reach age 59 and a half, you can access your IRA funds without penalty. From age 59 and a half to age 72 is the sweet spot for your IRA planning. And that's for most of our clients and the people we help live. The money is yours penalty-free if you choose to take a distribution. However, you're not required to withdraw specific amounts each year during the sweet spot, as you will be once RMDs are required. Take advantage of these years to take money from your IRA on your own schedule. If you're now retired and your income is lower, this may be the time to take taxable IRA distributions to reduce RMDs later. You might consider using these funds to purchase life insurance or fund an HSA, health savings account, if you're eligible. Really, really good information, Sarah. Let me pause there. I just dumped a lot of great slot information on you, and let me just see if there's any questions. Okay, no questions. All right. There was a good article that I saw in MarketWatch yesterday, late last night, I guess it was. I'm just going to share my screen with you. So you should see a MarketWatch article here. And MarketWatch, if you're interested in this stuff, I think MarketWatch is a pretty good site for looking at these things. But it was titled, why did the Dow tumble on Monday? Economic growth is now a bigger worry than inflation. So, the big concern here, and I highlighted it, is stagflation. So stagflation is when inflation is high and unemployment is also high. So that's a concern many people are having right now. And it refers back to the 70s. And the 70s is a really scary time because there's not a lot of assets that did well during the 70s. The stock market didn't do well. The bond market didn't necessarily do well, depending on what area you're looking at. So you're gonna hear that theme quite a bit with some of these analysts I'm talking about. But is this an area of concern? Well, of course it is. Should it be an area of panic? Well, it shouldn't if you're set up correctly. You remember the foundation you hear me talk about, just like the buildings in San Francisco where they have earthquakes. They build their buildings on foundations that will handle some shock, but hopefully they don't pull the buildings down. And but take a look at that article if you're so inclined. MarketWatch does have some good stuff there. And let me stop my share because now you're looking at my notes. Okay, I got to pull my notes back up. So looking back at the last couple of weeks, at the end of the week in July, July 9th. So that was the last time we talked, was the week of July 9th. The market was up slightly, 0.25%, still at 15% for the year. I'm talking about the Dow Jones Industrial Average. The S&P 500 is up 17% for the year. And year over year, we're still really high numbers. So from this time last year to this time this year, 38% and 40%. So this is where people are talking about, we really have these hyperinflated markets. When are they going to give? And I'm looking at the TV screen right now, and the Dow's up 470 points, which isn't all the loss yesterday, but it's still a very positive number. Now it's only 10:30, and that can change dramatically by the end of the day. So I don't know where it's going to end, but we do have a situation where we hit these levels of exuberance, the fear and greed kind of pendulum. You just want to stay balanced. You don't want to get too greedy and always looking for higher returns, and you want to set yourself up where you don't have to live in fear. And that's where, the asset allocation, principal protection, and account segmentation comes in, and managing each component of that is very, very important. But we had some positive markets, although slightly positive. There were some down markets around the world ending July 9th. Slight increases with the bond markets, and then that turned around the following week. So last week, ending July 16th, markets were down. So the S&P 500 was down just about 1%. The Dow Jones Industrial Average was down about 0.5%. Interest rates fell. Interest rates fell dramatically. I think dramatically yesterday. That's a concern, and that's where people are starting to have this stagflation discussion too, because as you've heard me say, these stimulus bullets are kind of running out. People are now getting their tax credits, child tax credits, forwarded to them ahead of time. But there's not much. I don't know what else the government can be putting out without just really imploding on itself as far as worrying about how to pay for these things, because they can't just be completely irresponsible in Washington. They do have to have some level of how are we going to pay for these things. Let's hope that's true. So there are these concerns out there. So you've got to be careful about where you are in the scale. And it's easy, a drop of 700 points in the market is easy to get fearful, but we didn't have any panic calls, so I'm happy to hear that. Okay, so let's talk about research reports. So Riverfront is someone I read every week. They come out with a couple reports a week, and they had some good key takeaways this past week. Negative yielding debt, the U.S. Treasury debt ceiling, and the Delta variant are factors we believe are driving the 10-year yield lower. So they're talking about the 10-year U.S. Treasury bond. The yield dropped down again significantly. We expect the 10-year Treasury to remain below 1.5% until tapering begins, and moving up to 1.5 to 1.75% range by year end. And then they go on and talk about covered calls. Covered calls allow, and this is not a recommendation, this is just something they're talking about. Covered calls allow investors to collect additional income using equity securities they already have in their portfolio. This is a really interesting strategy, one that we've looked at implementing for several years now. We're just trying, I would love to have a covered call strategy in our portfolio. It's really, it's another very complex layer, and it's very difficult to find a successful outside manager. Now, Riverfront has a newer program for covered calls, and they may be a good answer. And we're kind of in a due diligence process with them right now. But that it's basically you write calls on a position you own in a stock, and that allows you to get some payment just for that option. I know this is complex. There are risks involved, and the risk really is that you're sold out of a position that you may want to keep, and with that can come capital gains costs, and just having to repurchase that position if you still want it. Okay, so that's RiverSource. Again, Robert DiLucia from Prudential has a lot here, and I'm really gonna try to wrap up with that because it's 10:35. But this was a great piece again this week. So He writes, investors should be prepared for subpar rates of return over the next 5 years in virtually all asset classes. It's kind of like a redo of the 70s he's thinking about, I think. The economic and investment landscape will be challenged by a confluence of adverse underlying forces of both a cyclical and long-term structure. Virtually all asset classes are overvalued to a greater or lesser extent. The lesson is clear. The starting price level is crucial for prospective investment returns. History shows the expensive assets tend to generate subpar prospective returns when measured over many years. A central theme of my analysis, he writes, is that the next 5 years could be one of the most challenging periods of investing in recent decades. Financial markets face powerful headwinds pertaining to growth, inflation, government policy, and valuation. Spot on with that. So we've been really fortunate over the past decade, a little more than a decade. The markets have really done that. There's been blips along the way. We've really handled them quite well, but we have these massive headwinds. We're going to continue to see long-term effects from what happened last year with COVID. We still have supply and demand issues that's driving up costs, but it's also affecting, employment and all these other items. So growth, inflation, government policy, and valuation are really, really good points to make on that. He writes, the weakest 5-year period for stock investing was from 1999 to 2004, during which time the return on the S&P 500 was negative 2.5%. The worst 5-year period for investing in long-term government bonds was from 1964 to 1969, with an annual return of negative 2.2. The common denominator for each of these episodes of very weak return was overvaluation at the starting point of each 5-year period. The lesson is clear, he says again. The starting price level is crucial for prospective investment returns. Over the long term, expensive assets tend to generate subpar positive returns. The period from mid-2021 through mid-2026, he writes, can be divided into 2 stages: a period of rapid growth, moderate inflation, easy money, and stability in bond yields through 2023. A period of slowing growth, rapidly rising interest rates and inflation, and declining company earnings from 2024 to mid-2026. So now this is kind of a prediction he's making. But we won't know until we see what happens, again, looking in the rearview mirror, but they're really valid points. Obviously, I greatly respect the work this fellow does. Now, I don't invest a nickel in Prudential, but I really appreciate the research reports that they do. I'm just reading this, see what inflation is the principal wild card in the outlook, and acceleration in the inflation rate will be triggered by 2 events: a strong recovery in credit creation and a return to full employment. Inflation scares the heck out of me, folks. I'll tell you that, I've gone over the reports we get from the Bureau of Labor Statistics. Last week, it was 1% month over month, or really close. It might've been 0.9. But that's staggering. We can't continue. Even a 5% inflation rate is going to be really damaging. Many people are calling for 5.4. Some people are still saying 3. It could be. We have millions of people entering retirement every day, and if we have periods of subpar growth, like Robert says, even if it's not negative, but it's just flat, like it was in 2000 to 2010. The S&P 500 returned 0 from 2000 to 2010. So even if it's negative returns over that period of time, and we have higher inflation, higher taxes, it's going to be very, very difficult for people to live the life in retirement that they think they're going to be. So planning is vitally important. Structuring your assets the right way is vitally important. I am envisioning 2 or 3 years from now, we're going to have people looking back and saying, oh my gosh, if I would have just done it differently. So there's a lot more information in here. But I have a highlighted point here that I think is very important. He writes, it can be useful for investors to step back from the routine emphasis on short-term investment performance and to embrace a longer time horizon that extends well beyond the next year or 2. Very wise words. As you know, my philosophy includes account segmentation, which says let's set aside an amount of money that you're going to need for the next 0 to 3, 0 to 5 years, whatever your segment is, and then feather out the rest of the investments along your timeline. So that allows you to automatically think, Short term is good. I'm going to match that with mostly cash and bond assets, and then we grow out those returns that are more volatile, potentially the S&P 500, the stock market growth over the long term. So that forces that thought process, and I like that. Okay. So again, I always have the answer is asset allocation, principal protection, and account segmentation. Now you can't just gloss over asset allocation. Asset choice in that pie chart is very important, and it has to be something that is always reviewed. You know how we feel about the markets. We're defensively optimistic. We hope that we're going to continue with the growth here, but we're building those foundations so that if there are quakes along the way, our clients don't crumble down. So let's talk a little bit about Roth IRAs, just a little planning, and then I'm going to let you go. So there was an article, it was also in Market Watch. It just comes up on my feed that talked about putting your Roth IRA funds in, or putting your short-term emergency funds in Roth IRA. And it talked about the pros and cons a bit, but I think the cons heavily outweigh it. So I just thought it would be good for a discussion. There's nothing wrong with drawing on your Roth IRA during retirement, of course. And sometimes with some folks, we push that off until way in the future. Sometimes they're really legacy assets, longevity legacy assets. Sometimes we start triggering those in year 5, 6, 7. So it just depends. But the problem with thinking about it as a emergency fund is this: whether you're 59, it's much more complicated if you're under 59 and a half. But if you're drawing your Roth IRA funds and you're under 59 and a half, it's going to be a catastrophic event for you. And having the idea, now there are some exceptions to that. There's some home buying exceptions and college planning exceptions, but I'm just talking about non-exception withdrawals. But if you read an article like this and say, hey, that's, I'll end up with, if I have $50,000 in my Roth IRA, I consider that my short-term cash. Well, first of all, you don't want to invest very aggressively in what you want your short-term cash reserves for, right? Your short-term emergency money. And I would argue that for most people, Roth IRAs should be the more aggressive type of investments, depending on where they are on your timeline. And the other part is you can't put it back, right? So we do a lot of work. We convert from an IRA to a Roth IRA. You pay the tax along the way, or you're painstakingly contributing to your Roth 401k or your Roth IRA to finally get a decent amount in there, because it takes a long time to build up assets in a Roth IRA just via contributions. Forget about the billionaire, turn $2,000 into $5 billion. I mean, that was PayPal, and he bought it at pennies a share, and those things don't happen on a regular basis. But it takes a long time to build up Roth IRA funds. And if you suddenly need, even if it's $10,000 in out of your Roth IRA, how do you get that back? Well, the answer is, if you're not working anymore, you're unemployed, whatever situation caused you to take that money out of the Roth IRA, you can't put it back. You have income limitations on contributions in a Roth IRA. You also have just the ceilings. You can only invest so much. And so it's not as though you can just, it's not like a bank account where you can take money and put, we had to buy a new car for my wife, and I was on the phone with the bank and the car company yesterday. And we needed instructions on where to send funds. And we're moving money from one account to another, within the bank. And you can't and I said to her, that's okay, do this, and I'll put money back into it from the savings account. You can't do that with a Roth IRA, right? But there's no mechanism beyond a 60-day rollover, the 60-day rollover loan, which, as you've heard me say, that's really tricky and should be avoided. There's no mechanism to get that money back. So be cautious about that. All right. It is 10:44. So much for my short webinar today. Sorry to keep you. That's it for today. I will see you all tomorrow night, and we're going to talk about investments. When you log off, you're going to see my calendar. I have some, I am booked. I've got one appointment left tomorrow, one appointment on Friday, and I've got some time next week. If you want to set up a consultation with me, if you're not already a client and you may be new to the webinars, we have limited the number of clients we're taking. We take about really 2 a month. I'm hopeful. We had to stop in, this is a great problem, and I'm appreciative of it. We had to stop in April, May, and June, accepting new clients, just to be sure. We kind of measure where we are as far as capacity. We do a lot of work during the onboarding process, the financial planning process, first time around for sure. And we need to make sure that we're servicing all the clients we have. We'd like to keep it small for sure, but we're very aware of the stress that having a lot of clients at once can cause on the service of our existing clients, and our existing clients are very, very important to us, obviously. So what we've decided to do is limit it to about 2 clients a month. So I'm hoping using that we won't have to put a moratorium on things. We may have to pause in September and October, but I'll let you know about that. So right now we're limiting to 2 new clients a month, and again, we may have to pause in September, October. So if you're on the fence, you can delay, you can do whatever you want. Just don't get upset with me if we have to delay things a little bit for you. And I know it's hard sometimes, because once you buy into it and once you understand it, you want to get it fixed quickly. But we'll get there. All right, folks. So you should have my calendar. You can schedule time and we'll figure out how to make it work for you. I hope that was informative. I hope it was helpful. Let me just check to see. No questions. Have a great day, and we'll see you tomorrow. Take care.
Hello again. I hope you enjoyed the video and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.